the Fed's latest move. After cutting the rate, watch what he did Friday afternoon. So the only way to explain this is with an analogy. So imagine you're a bit short on cash until your next paycheck, but you got a nice watch. So you need cash. You go to a pawn shop, right? You offer the collateral. So you're going to give the broker your gold watch and you get cash. The pawnbroker say gives you $500 in cash, and the agreement is you both agree tomorrow you come back in and you're going to pay the $500 back plus a small fee and you get your watch back. That, in essence, is a repo. Now, the Fed does the same thing. So let's translate it to the financial world. You're a bank, you need cash for a short period. You go to the pawnbroker, which is the Federal Reserve, or another lender with excess cash. The gold watch is something like super safe treasuries, treasury bonds. So that $500 cash is the short term loan, the overnight loan, usually though tens of billions of dollars, and the $1 fee is the repo interest rate. So a repo is simply a short-term loan where the bank uses its high-quality stuff as collateral just to borrow cash, usually overnight. So why is the move that happened on Friday so important, where they borrowed more money overnight than they did during COVID? Because banks are legally required to have a certain amount of cash in the vault. It's called reserves at the end of each day. And sometimes due to normal business flows, tax payments, large wire transfers, things like that, they end up short on cash and they go to the repo market. So the repo market's kind of like the plumbing that moves this cash from sitting where it's needed to ensuring that the whole financial system runs smoothly. And it prevents temporary cash shortages at one bank from causing a freeze in lending or a spike in interest rates. So put this all together though. The Fed's $29.4 billion operation, they injected that into the market, more than COVID days. And the problem here, several banks found themselves short of the cash they needed to meet their reserve requirements. So the overall bank reserves have been falling as they ease this quantitative easing. But the banks went to the Fed basically and said, here's some of our treasury bonds as collateral. Please lend us this overnight. So the Fed creates this new money electronically and they lent it to the banks. The next day, the banks will repay that $29.4 billion plus a small amount of interest and they get their bonds back. So it's a secured short-term loan that keeps the daily cash flow of the banks moving. So why is this one so important? Because likely a temporary cash shortage is fine. They can be patched